You know, the stock market can feel, well, kind of like a maze, right? You've got dozens of competing philosophies, each one with its own cheering section, all promising they've got the secret sauce. It's just so much noise. But what if there was a way to find a clear signal in all of it? I mean, it's a classic case of analysis paralysis. Are you supposed to be a value investor, a momentum trader, a contrarian? The options just seem endless. And if we're being honest, it's pretty overwhelming. But what if a single, simple framework could help you cut right through all that? Well, that's where Raamdeo Agrawal, the co-founder of Motilal Oswal, comes in. After spending decades studying the markets, he basically boiled down his entire philosophy into this incredibly powerful and clear framework. And he argues that really it all comes down to just two fundamental sources of wealth. Yeah, that's right. Agrawal says that if you strip away all the jargon and all the complexity, every single successful business creates its value through a combination of just two things. And I just love this analogy he uses. Think of quality as the engine. It's the wealth-making machine itself. It's a business that just reliably churns out profit. But growth? That's the accelerator. That's the multiplier that takes that amazing machine and just launches it onto the superhighway. These two things are the absolute foundation of his QGLP framework. So let's start with the Q. So, what exactly is a quality business? It's a term that gets thrown around all the time, but Raamdeo Agrawal has a very specific, and I think, brilliant definition. See, a quality business isn't just one that makes money, it's one that's capital efficient. It doesn't need you to keep pouring money into it just to keep the lights on. It's the total opposite of what he calls a bottomless pit of capital destruction. Those companies that look profitable on the surface but are actually just burning through cash. A quality company generates wealth without eating it. So, who makes sure that happens? The people running the show. And this is absolutely critical, the human element. Agrawal says you have to look for three things in management. And think about it, you need all three. Integrity without competence is, well, useless. Competence without a growth mindset means you're just gonna stagnate. You need to be able to answer yes to all three questions. Can you trust them? Do they actually know what they're doing? And are they hungry to get better? Now keep that first one, integrity, in the back of your mind. Trust me, it's gonna come up again in a really big way later on. Okay, so you've found a quality business with a great team. Check. Now for the fun part, the multiplier effect, that explosive growth. So how do you spot it? Well, Agrawal gives us a couple of really powerful ways to think about this. One of his big ideas is something called value migration. The concept is pretty simple. Value, we're talking profits, market share, all of it, it doesn't just sit still, it flows. It flows away from old, outdated business models and rushes towards new ones that are serving customers better. The classic example he gives is the huge shift from landline phones to mobile phones. The value literally just migrated to where the innovation was happening. Now, to make this idea of growth even more real, just look at this number. Agrawal calls this the next trillion-dollar opportunity. The entire Indian economy is projected to double from $4 trillion to $8 trillion by the early 2030s. Just think about that for a second. The amount of wealth that was created over the last 75 years is basically going to be created again in less than a decade. That is a massive tailwind for any company that's positioned to ride that wave. So, we've covered quality and growth, the engines of wealth. But look, a great engine and a fast car aren't quite enough. The QGLP framework adds two final, absolutely crucial filters. How long can this thing last? And what's the right price to pay for it? And that brings us to longevity and price. Longevity isn't about next quarter's earnings report. It's a question of durability. Is this business actually built to last? Can it keep up its quality and its growth for decades to come? The market is always trying to figure this out, trying to peer into the future to decide if a company is just a flash in the pan or if it's an institution in the making. And that perception of longevity, it has a huge impact on the price you pay today. And finally, we get to price. After you've looked at the quality, the potential for growth, and the longevity, you have to ask one last simple question. What am I paying for all this? Because even the best company on the planet can be a terrible investment if you overpay. This really brings the whole framework together. But you know, theory is one thing. Let's look at a real-world story where one of these principles was ignored, with some pretty devastating results. So this is a story Raamdeo Agrawal tells about himself. It's about a mistake that cost him, personally, over 100 crore rupees. That's more than 12 million US dollars. It's just such a powerful lesson that drives home the entire QGLP philosophy. It all started with a company that, on paper, looked absolutely perfect. The numbers were incredible. The growth was off the charts. The return on equity was sky high. I mean, it ticked all the right boxes, or so it seemed. So here's how it all went down. The investment was in this really popular mango drink company. The analyst ran all the numbers, and they just looked fantastic. But there were whispers. There were red flags about the integrity of the person who started the company. And here is the most crucial part. Agrawal admits he ignored them. He let those beautiful numbers completely override his gut instinct. Well, the truth eventually came out. The company was a total fraud. They were running 2 sets of books. The entire investment was wiped out. Gone. The lesson was just brutal, but it was crystal clear. Growth, longevity, and price mean absolutely nothing if that Q for quality is broken. And what's the most important part of quality? Management integrity. The numbers, no matter how good they look, can be a complete work of fiction. The character of the people in charge, that is the bedrock that everything else is built on. So this entire framework and that really painful lesson, it all boils down to one central idea that separates people who just speculate from people who are serious investors. This might be Agrawal's most famous quote. It just perfectly captures both the challenge and the opportunity of the stock market. The price, it's right there on your screen for the whole world to see. It's public information. But the true value, well, that's a whole different story. And this really frames the job of an investor perfectly. Price is the easy part. It's what you pay today based on what everyone thinks right now. Value is the hard part. It's what you actually get over the long run. And it's determined by the company's quality, its growth, and its longevity. Your entire job is to find the gap between those two things, to find those situations where the true value is way higher than the price tag. That is the entire game. And that brings us to the final question this framework forces you to ask yourself every single time you look at an investment. Are you just reacting to a flickering price on a screen, getting caught up in today's fleeting opinion? Or are you actually taking the time to understand the underlying business, the machine, the multiplier, and how long it can last, so you can truly invest in its long-term value? The answer to that question can make all the difference.